Systematic investment strategies run contrary to the notion that markets are efficient and instead use data-driven statistical inference and modern computing to identify trading signals. Trend-following strategies are one of the oldest of these systematic approaches and use technical analysis of market prices to determine portfolio positioning, rather than any analysis of fundamental strengths or weaknesses of the underlying assets or securities. But simply, a trend-following system seeks to identify a trend, measure its strength, and scale an appropriate position both long or short to profit from it. Today we delve into the strategy, how it has evolved since its development in the 1980s, and its value within a portfolio, in a conversation with Nick Thomas-Peter, a senior quantitative researcher at Winton. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Nick Thomas-Peter, a senior researcher at Winton, the quantitative investment management firm which manages over $13 billion of assets across its suite of systematic, data-driven investment strategies. Nick joined Winton in 2012 and has held various roles for the business within research, strategy management and portfolio oversight, and across many of the strategies run by the company. He also works directly with Sir David Harding, one of the pioneers of trend following as an investment strategy. The existence of trends has been observed throughout the history of markets, and the reason they exist can be explained by the way information is disseminated through market participants and by behavioural finance. Economists and psychologists have identified persistent biases within markets that lead to human tendencies to overreact, to herd, and to extrapolate the recent past. We've discussed many of these behavioural traits in a number of the prior episodes of the Investor Insights series, but there's perhaps no single strategy which focuses on the impact they have on markets as directly as that of trend following. The historical return profile of trend-following strategies is an attractive one in our view, and it is strategies such as this that can add significant value to the long-term return profile of a multi-asset portfolio. The performance in 2022 provides a very good example of the value of such a holding, with the strategy producing a strong, uncorrelated return against the backdrop of both equities and fixed income markets falling in tandem. The Winton strategy is a constituent of Killik Co's alternative allocation investment strategy, which curates a diverse portfolio of uncorrelated strategies, such as trend following, amongst others, alongside other alternative investments, such as commercial property, infrastructure, commodities, and other asset-backed and inflation-linked assets. We hope you enjoy this discussion, and as always, please do get in contact with us if you'd like any further explanation of any of the terminology referenced in this interview, or for further information on the Winton strategy or our alternative allocation proposition. Hi Nick, good afternoon. Thank you so much for sparing some time for this. How are you doing today?
Very well, thank you. We've made it to Friday, so things are all okay.
Yeah, it's sunny Friday here. Yeah, and so Nick, we've got this standard first question that we ask everyone on this series actually, and it is really just aimed just to try and get a bit of an insight into you, kind of how you go about your work, and learn a bit more about you. Really, I wondered if there was a a kind of anecdote you could share, or a research project, or something you could share about yourself that would kind of give us a bit of an insight?
Why don't I give you just a brief background of me? I've been at Winton now for 13 or so years. I'm a senior researcher with the company, and across that 13 years, I've worked across most areas of what we do, and that includes the trend following piece, which is relevant for today's conversation. I'm a physicist by training. I did an undergraduate and PhD in atomic and laser physics, both at Oxford University. And my day job now is to work on the design and development of trading strategies. Most recently, I'm focusing on slightly higher, slightly faster trading strategies within the firm. By way of any anecdotes, the only potentially interesting thing is that occasionally I am let out to go and speak to clients and prospective clients, and I was doing that last week actually in North America, speaking to a cohort of public pension plans in North America, and that's of note only because of particular interest to them at the moment are risk mitigation strategies, risk mitigation portfolios, and trend following is a natural piece of those portfolios because of its characteristics with respect to equity market drawdowns and its consistent returns over a long period of time.
No, interesting to see investors like that get more interested in this space. Yeah, thank you for that. Nick, I wondered, as a kind of brief introduction, perhaps to the kind of rest of the discussion, if I could ask you to kind of give a kind of trend following 101, if I may, just kind of a bit of a brief explanation about what trend is, what determines positioning, and the kind of environments that the strategy favors. If you could kind of run through a kind of brief summary there.
Yeah, absolutely. So trend following as a strategy was pioneered by a number of individuals in the 1980s, including Sir David Harding, who founded Winton in 1997. He recognized that markets have a tendency to continue in the direction that they've been going over the more recent past. And if you can measure that trend, then you can make money by betting that the trend is going to continue. And that's really the conceptual underpinning of a trend following strategy. It's no more complicated than that. There are details to it, but it's easy to grasp at that level. Now, the effect is very weak when you look at it from the perspective of a single asset that you're trading. If you try and look at it in just the S&P 500, or if you try and look at it in just crude oil or just corn or just the euro, it's difficult to see it. Where it becomes very powerful and a meaningful proposition is if you can implement it across a portfolio of diversified assets. And so that's a key part of what we do. We trade 150 or so futures and OTC FX markets in the UCITS trend product, and it's trying to build that portfolio. Now we get exposure, directional exposure, long or short, to each of these markets. Trend is a strategy which can be long or short, and it does that very naturally using futures markets. We're measuring the trend by looking at the recent price movements in any individual markets and comparing that over a couple of different timescales. So if a market has been going up, then we bet that it will continue to go up and we take a long position. If the market has been going down, then we bet that it will continue to go down and take a short position. One of the characteristics of trend following that's important to understand is that it always misses the beginning and the end of the trend. We have to wait for a trend to build. It's trend following, not trend prediction. So we have to wait for a trend to build before we can take a position. And equally, we have to wait for a trend to reverse before we exit that position. We do size our positions in response to how strong the trend is. So we're trying to estimate how strong the trend is, and all else being equal, we will take a larger position if the trend is stronger, and a smaller position if it's weaker. We also size our position in inverse proportion to volatility. So if volatility increases, then we will take risk off the table, we'll reduce our position, and if it decreases, then we'll tend to increase our position, subject to sensible caps. And then we also have an overall level of gearing which we have to choose for the product, and that goes into sizing our position as well. Other considerations around position sizing are about capacity for individual markets, the costs in individual markets. You mentioned environments that tend to favor trend following. Well, I've talked already about the value of diversification in the underlying assets that we're trading and trying to maintain diversity there. So if you're seeing high pairwise correlations, a lack of diversity in the instruments that you're trading, that's not so good for a trend following portfolio. And they also, trend following as a strategy doesn't do well when markets are very range bound or very choppy, because they're being given lots of new information to digest, and that's changing very, very rapidly. And actually, the choppiness has been a feature, you would probably argue, of markets year to date, and trend following has had a more difficult time of it as a result of that.
Actually, Nick, I was going to ask you to explore that more recent period of performance, which has been a kind of more volatile period for investment markets in general, kind of brought about largely by the actions of the new US administration. But this seems like a kind of good segue to talk about that here. Could you kind of run us through the most recent experience from the perspective of trend following, that kind of year to date period?
Absolutely. So it has been a more difficult environment for trend following, or a more difficult period of time for trend following is probably a better description. We have seen equity markets pull back, and trend following hasn't yet shown positive performance as a result of that. I think it's interesting to bear in mind the historical context of how trend following has tended to behave in the event of an extended equity market drawdown, and the kind of thing where investors hope that trend following is going to provide some offsetting positive performance. I think if you take the sort of top 20 equity market drawdowns since 1970 or so, and look at what happens, the performance of trend following in the first 2, 4, 6 weeks, couple of months of those, what you tend to see is that trend following loses money in that period of time. And the reason why is fairly clear. Those reversals have happened after a period of positive performance. And so trend following is the wrong side of that when reversal when it comes. And as I mentioned right at the beginning, trend following as a strategy misses the turn, both at the entry and at the exit. And that's what we're seeing right now. If you look at what happens after those points, then it's later in the drawdown that trend following can start to become very profitable. And if we can continue to see drawdowns in equity markets, then that could be a positive place for trend following as a strategy.
I think that summarizes things well. So thank you for that. I mean, there's always a lot of debate within the industry about what differentiates, because the kind of various trend or CTA strategies they're out there. I wondered if I could ask you to kind of summarize how Winton's approach has kind of evolved through the years, and kind of how it approaches some of those debates about kind of the differentiating factors that you use.
That's absolutely right. I think we see that there are probably 3 key battle lines to be drawn across the cohort of trend followers. There's a 4th one you can add if you talk about CTA more broadly, but for trend following, there are 3. And those 3 are the speed of the trend following strategies, the universe of instruments that are traded, and the risk management processes that are in place in order to oversee and manage the trend following strategy. And I'll just take each one of those in turn, and we can talk about them individually. Perhaps the most important one is speed. That's been a big distinguisher between different trend followers over the years. And it's a picture which has evolved considerably over time. If you go back to the 1970s, 1980s, even into 1990s, it was fairly clear that the best trend following strategies for predicting the future were the fastest trend following strategies before before thinking about transaction costs. And those strategies were also the same ones which gave you the best return profiles in the context of equity market drawdowns. They would give you better convexity with respect to those to equity market drawdowns. And so it was better to be faster. All else being equal, it was better to be faster. As time has progressed, the best signals for predicting the future, trend signals for predicting the future, are now the very slowest trend following signals. The first evidence that was available for that shift in the relationship was in 2007, 2008. And it was at that time, actually, that Winton began to slow down its trend following models and move away from the fastest end towards the slower end of trend following. More recently, though, that introduces a bit of a tension because that changes how the product behaves with respect to how trend following behaves with respect to equity market drawdowns. You give away some of its ability to get short quickly of equity markets in the event that equity markets are entering a drawdown, because it just takes a longer time for the trend following signal to turn around. So what we do actually is step back from the very slowest end of trend following in order to improve the how it will behave alongside a long exposure to equity markets. And we do that because we know that for our clients and for our investors, it typically sits alongside a big exposure to equity markets. So that's speed. The second one is universe, and I've already alluded to this in a number of times by mentioning diversification. It's really important for trend following to be expressed on a broad array of markets which have low correlation to each other, i.e. a very diverse set of markets. We naturally have exposure to lots of different types of market because we trade futures markets, which gives us global access to equity indices, fixed income markets, currency markets, and commodity markets. But it's important not just that we have a large number of markets, but that those markets do have that low correlation properties, that diversity. A great example for case in point, really, for the benefit of including markets which really are diversifying to each other is Cocoa in 2024. Now, Cocoa has been in the portfolio for a very long time, but at the beginning of 2024, it hadn't done much for us for the best part of 15 years. It's a standalone market. It hadn't lost its money, but it hadn't done very much for us. Nevertheless, our baseline view is that all of these markets are equally likely to display trends. We just don't know which one is going to do it at any given time. So we keep it in the portfolio for that reason. And then 2024 comes along, and Cocoa 3.5 times in price in a fairly short period of time. It's a major contributor to the portfolio in that year. So that's a really good example why it's important to try and find these markets which have low correlation to other things, because you never know which of them is going to display trends and which ones will contribute to the portfolio at any given time. So that's the universe piece. And then the third piece is risk management. And that's often again, a distinguishing feature, a distinguishing characteristic between different managers, and the way that managers handle particularly difficult periods of time can have a big impact on the dispersion across the cohort of trend managers. Now, Winton has been around for a long period of time. We were founded in 1997, and we've lived through a number of different episodes that have affected trend following quantitative strategies, and also big events that have happened and that have affected the world more broadly. I think a good summary of our philosophy with respect to risk management is the recognition that portfolio volatility, and the volatility of your P&L isn't the same as the investment risk that you really care about. It's a neat statistic. We can summarize things using that statistic, but it doesn't capture everything that we care about. In particular, it makes assumptions about the structure of markets and how they're related to one another, and how that manifests in the correlations between those markets. Now, we're very aware that that structure is not constant. It changes through time. It can change really, really quickly. And there have been some big examples in the last few years where that's happened. The Silicon Valley Bank episode in March 2023 was a really good example of correlation structure changing dramatically. So in that environment, we were not as highly geared. We weren't using as much leverage as some of our peers, because we had a number of scenario tests that we employ that were showing to us that if correlations change dramatically, if the structure of markets change dramatically and quickly, and we would be left exposed. And so we were managing our overall level of leverage, our overall level of gearing, with that in mind. Lo and behold, what happened was Silicon Valley Bank imploded, and the ramifications of that rippled through financial markets, and a number of our peers in the industry had some pretty rough days. We rebounded pretty quickly. We didn't lose very much in the event anyway. We didn't have to take any action, and we rebounded very, very quickly. Some in the industry lost significant, approaching double-digit losses, and then didn't rebound so much. That's a very difficult position, one that we were able to avoid. And in that year, we outperformed the benchmark significantly, and a big portion of that was as a result of our risk management around the Silicon Valley Bank episode. So those are the three big differentiators, we think: speed, universe, and risk management. If you're talking about beyond trend, then and CTAs more broadly, then we would add to that what else are they trading? What are the other signals? How can you add to trend following? But for trend following in particular, it's those first three: speed, universe, and risk management.
Yeah, there's some really interesting points in there. Thank you. As you've mentioned in an earlier question, trend's been around for a long period of time. The Winton business kind of set up for that trend following strategy. But whenever we kind of meet you guys, there's always a kind of it's clear there's a big emphasis on research and development of all strategies. Really, you've got kind of pure trend as well as other bits and pieces, other strategies, and doing other things. I wondered if there were kind of any findings from recent projects that you and the team have been working on that you could share for this audience, just to kind of give us a kind of feel for that kind of R&D that's going on.
Yeah, absolutely. As you rightly point out, Winton was founded with the idea that you can find these ways of systematically predicting markets, and that we should try and find as many of them as we can and try and exploit them as broadly as we can. Trend following was and is the core example of that. It's our lifeblood, so to speak. But we've been active in adding many other signals, quantitative strategies to that stable over time. The reality for trend following is that it's a very mature signal for us, something that we're very comfortable with and have developed over an extended period of time. And the job of research in the context of trend following is to make sure that we're staying on top of appropriate parameterization. So are we managing it properly with respect to speed? Do we have the right universe, or are there other assets that we can add to it in order to improve it further? Do we have our risk management statistics in place properly? Are we capturing the risks that we care about, and are we able to respond to them? And those are the research jobs with respect to trend following. Across the firm more broadly, the research focuses on medium frequency strategies, so things which are a little bit faster than our core trend models. And those are in development across both equities, cash equities, which we trade in other programs, as well as futures markets too, macro markets. And in addition to that, volatility strategies, which would be implemented using options, those are also in development. And both of those two areas are places where we expect to have new signals being brought online in the second half of this year.
Okay, yeah, so watch the space on that. Nick, we obviously, as part of this series, speak to a lot of of equity portfolio managers. And one thing there's kind of been a recurring theme with some of those discussions is talking about some of those kind of noteworthy changes in kind of broader equity and investment markets over the last kind of few years. Things like that kind of increasing concentration within equities, or the kind of rise of passive ownership, as well as obviously that big change in the kind of interest rate environment that we've had. I'd just be interested in your take on how some of those big changes, some of them will perhaps be less relevant than others, but how that's kind of changed the outlook for trend following in your mind.
I think our view is that it hasn't really changed the outlook for trend following in lots of ways. I think we certainly don't expect trend following to behave worse in any meaningful way as a result of changes that we've seen more recently. I think equity concentration in indices, yes, we will see that in the futures to some degree, but we have a pretty broad basket of equity index futures, and the equity index futures themselves are only a portion of our portfolio. Increased interest rates across the board is of course interesting to the extent that it precipitates trends in futures markets in the fixed income space. Perhaps of more interest is what we've seen more recently in this year with the kind of decoupling between North America and Europe on defense spending and the impacts that we've seen in those markets as a result. That is a reduction in correlation or an increase in diversification across those two markets, which could be beneficial for trend following by maintaining that at the portfolio level. Those are the kinds of things that we're interested in. I don't think we don't have a belief that trend following is going to behave materially differently now than it would have done 6 to 12 months ago.
Yeah, I guess it does seem somewhat possible, probable even, that given the kind of changes that are ongoing in terms of trade policy or different outlooks, economic outlooks that we have kind of globally, that dispersion in returns between global equity regions could be wider than it has been, or correlation is certainly much lower. That does seem like it could feed into a better opportunity set for trend following. And I guess one of the other kind of direct factors that influence trend following strategies, as well as other kind of hedge fund strategies, is that when prevailing interest rates are now higher, certainly a lot higher than they have been for the last kind of 2 decades, and also the expectations for kind of near-term interest rate cuts are a lot more muted, that a lot of the exposure within the Winton strategy is gained through the use of futures. So they're traded on margin, which means that only a kind of small portion of cash is actually placed on exchange, and the rest can be held in cash-like instruments and earn that higher prevailing interest rate. So that's all kind of additive to the overall returns of the strategies. Thought it might be useful just to kind of point that out also. Winton, I read the team recently published a kind of paper or a piece of analysis which kind of tried to assess whether it's possible to kind of time investment into trend following. And I know that's another thing that's often debated about whether that's possible, rather than just owning through the cycle and continue to have that ownership over kind of better and worse periods of performance. I wondered if I could ask you to kind of summarize the key conclusions that you had from that paper.
The summary is a very short one, which is that it's extremely difficult, if not impossible, to time the trend following allocation. When we looked at it in that paper, we're looking at it from the perspective of an institution, really, which is trying to time its allocations to trend following. So the timescales involved are institutional timescales. But I think what we did in that paper is think about a 60-40 portfolio, traditional 60-40 portfolio, and look at those periods of time when trend following is additive to a 60-40 portfolio, and whether or not you can use that in the first instance to time an allocation to trend following. If you just step back, all of this comes from an observation that if you add trend following to a 60-40 portfolio, I take someone a little bit away from the 60-40 and add it and give that to trend following instead, the overall portfolio would have done better. It would have done particularly better in periods of time when there's been equity market drawdowns, because those have been periods of time historically anyway where trend following has done well. So in the paper, when we looked at a number of different ways to try and time that allocation to trend following, whether that is through measurements of lack of diversification between stocks and bonds, whether it is as a result of the recent benefit of a trend following portfolio to a 60-40 portfolio, or a number of other different ways, none of them actually is as good as, or would have been as good as, a strategic allocation to trend following at a level which makes the investor comfortable.
Yeah, no, thank you for that. It's an important point in there. Nick, it'd be really interesting to chat to you. Some really interesting discussion points in there. I really appreciate your time. Thank you.
You're very welcome. Thanks for having me on board.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.